Amid a second surge of viral cases and the expanding political polarization, investors have been worried about the looming stock market crash like never before. Even though the health crisis implications are not enough to scare investors away anymore, market strategists have reason to believe that the effects of the widespread lockdowns already unleashed several catalysts that have been quietly causing the stock market crash. And now, a change in mass psychology will likely depress the markets even further. Moreover, experts warn that the huge tech bubble that's been growing for years has already popped, and its effects will potentially act as the black swan event needed to boost an unprecedented crash. Today, we're going to examine the most recent developments of the coming stock market crash and analyze its formation in the light of the assessment of prominent authorities in the field. So stay with us, and don't forget to give this video a thumbs up. Please share it with friends and subscribe to our channel to keep updated with the next unfoldings of the 21st century economic depression. Despite the growing number of viral infections, stock markets continue to register record highs. The health crisis effects alone don't seem to scare investors that much anymore. That's why market watchers are arguing that the forthcoming stock market crash appears to have been exhausted in the crash of February and March 2020. Now, experts don't believe a new wave of viral infection cases alone will drive investors to hit the brakes and pant towards the exit. However, given that the sanitary outbreak has reminded the world how unexpected events can crush expectations very rapidly, investors have been discussing how a black swan event is now on the horizon. And even though the outbreak repercussions may not be seen as the biggest threat for the markets at the present day, they've sparked a number of other triggers that are already silently causing the next stock market crash. Market expert Andre Castellani has once made a comparison between the economy and the stock market to a dog and its owner during a walk. As ironic as it sounds, the analogy is meant to explain how sometimes one is running in the front, sometimes the other takes the lead of the walk. Both arrive at their destination relatively at the same time. At the stage we're in now, markets are walking way past the economy, confident with their prices hitting all-time highs, but taking a short break while waiting for the economy to keep up. When we look at the individual countries' economies, the recovery has increasingly flatlined. In some states, business activities have declined once again, such as in the United States, Canada, the United Kingdom, and Sweden. Although the US is presenting a slightly better outlook compared to other countries, it's still 20% below the activity at the beginning of the year, as we can observe in this chart. In that sense, it's crystal clear that our economy is lagging behind the stock markets. The crash experienced in February and March and the second quarter of 2020 has created a massive deterioration in the economy that needs to be assessed before even considering a retake to previous levels. Just by looking at the gross domestic product, we can come to the realization that it will take years for many countries to reach the pre-outbreak levels again. The most optimistic prospects point out that it will take, at the very least, until 2022 for the US economy to see a significant recovery. In spite of such projections, stock markets keep rising and having more edge over the real economy. Why do they manage to stay that way? It's what a Seeking Alpha article answered recently. According to the leading investment company Viewpoint, there are several reasons for this, and as so often, no one can assign individual cases and their effects. However, it is apparent that a considerable amount of money is flowing into the market, and it does not look as if this cash flow will stop soon. This money comes from many sources and ensures that the demand for shares at least remains stable. In their analysis, they outline how governments worldwide turn to the issuance of gigantic bailouts of historic proportions throughout the current global economic collapse, and the speculation surrounding economic stimulus packages have recently kept share prices high. Here, we can see how the international bailouts by governments of the G7 states in 2020 were the largest ever recorded, which consequently created a colossal debt burden that's reached nearly 3 times GDP. Needless to say, that the core problem of this scenario is that markets have grown not because of a better economic landscape, but due to the expectation that the federal government will continue to shoot liquidity injections all over the markets. That's where things get tricky. Evidently, stimulus money will resonate in the company's business performance. That money has got to go somewhere. But as the article explained, these packages cannot do more than keeping the patient alive for the time being. They ensure that the economy is halfway running, that the companies have a business and can continue to pay their employees. The employees can, in turn, spend the money on consumption. The cycle remains intact, which is a good thing if it can prevent pain and suffering for workers, families, and individuals. Furthermore, an additional source of cash is the money market funds, which envisions to maintain a highly stable asset base through liquid investments. For its part, those consist of cash securities and bonds with terms shorter than 12 months. Some private retailers also have access, but they are a minority. On that note, the money market fund is led by institutional investors such as banks, insurance companies, and governments. In the past few years, the inflows into money market funds have steadily escalated, and after the health crisis prompted widespread lockdowns, an additional shift of capital happened into money market funds. That is to say, the money overflow inside the stock markets created the substantial distortion seen by the end of February. While the value of net assets is still dramatically higher than pre-outbreak levels, now they've started to decline. Every month, cash is redirected out of these funds and into the stock markets, and the idea of so much money on the side is enough to provoke euphoria amongst investors. Additionally, private investors' demand for shares have been spiraling upwards like never before. With the help of discount brokers and motivated by rising prices, investors are able to promptly pump money into the stock markets, which makes the perfect scenario for a self-fulfilling prophecy. A Seeking Alpha market analyst described cheap brokers with almost free trades, a sizable blogging scene with investors who mantra-like promise early retirement if you only buy stocks regularly, have, in my opinion, created the perfect mixture for a bubble. Besides, after years of waiting for the next crash, there is a great fear of missing the next rally. Whether private households can move the market in this way is of course not clear and difficult to prove, but it cannot be ruled out. To further illustrate this parabolic investor ascent towards the top, David Einhorn has shared an irreverent event that happened at his company, Greenlight Capital. He disclosed that they recently received a job application with the email subject, "I am young but good at investments," which came from a 13-year-old who claimed to have quadrupled his money since February. This toppy behavior, as he defines, is a warning sign, pointing that the stock market, indeed, is inside of a bubble. Likewise, the Nobel-winning economist Robert Shiller has highlighted the dangers of a market crowded with new, inexperienced investors. In an opinion article for the New York Times, Shiller noted that another spike in infection cases and a chaotic political scenery could shake people up, and any resemblance between the market now and the market before previous crashes could, quote, create a psychological sense of the risk, unquote. Shiller said the decision to invest in the stock market is for some people a bit of adventure, outlining that the market may be vulnerable to a change in mass psychology, one that might dampen this sense of adventure and bring on a crash. Shiller revealed that there are many indicators demonstrating that investors are more nervous than ever about the stock market. One of those could be seen on his Crash Confidence Index, which tracks how many investors say the probability of a catastrophic market crash in the U.S. is. According to his data, an overwhelming majority of investors said there was a greater than 10% probability of an imminent crash. Really, a remarkable indicator that people are quite worried. Another one of his indexes, the Valuation Confidence Index, has also registered a near-record low, showing that the large number of investors believe the market is too highly priced. Shiller added that the CAPE ratio, which he helped to develop, indicated that the market is now similarly valued as during the stages that preceded the Great Depression and the dot-com bubble burst in the early 2000s. Correspondingly, in his latest letter to investors of his Greenlight hedge fund, David Einhorn emphasized that the comparisons investors have been making to previous bubbles might only inflame their fearful mindset and make the situation worse, as he describes that some analysts and commentators are comparing this bubble to the prior one. Have the valuations reached the prior insanity? Is the IPO mania just as large? Are the companies better today? Are they growing faster? And have the specific events that popped the last bubble happened, and are they likely to happen soon? We believe these questions are a fool's errand. The bubbles will never be exactly the same. The expert then suggests that this analysis is totally arbitrary, saying that in 2000, the NASDAQ peaked at 5,000. But why not 4,000, he asks. Why not 10 or 20,000? Would there really have been a difference? If the NASDAQ had peaked at 3,500 instead of 5,000, the losses would have been 65% instead of 80%. Had it peaked at 3,500, it would be easier to argue that this bubble has surpassed that one. Had it peaked at 20,000, it would be easier to argue that there's still a long way to go. Is a bubble only dangerous when it's exceeded the prior one on every metric? Einhorn defends that what matters the most to foresee a market bubble burst is market psychology, not valuation. In fact, he affirms that valuation is irrelevant. It's merely what fuels the bubble in the first place. The question we should be asking now is where we are in the psychology of this bubble. During the dot-com bubble of 2000 on March 10th, nobody could see that it was the top. Even by September 2000, it wasn't apparent. There was no evident occurrence that marked the top. Only by looking in retrospect is when people can try to explain what happened. Besides, bubbles tend to topple under their own weight, and he believes that by now, everybody is already inside the bubble, saying the last buyer has bought, and the last short has covered it. When a downfall starts, the psychology shifts from greed to complacency to worry to panic. For that reason, the expert points out that the enormous tech bubble already popped on September 2nd, the day the S&P 500 and the NASDAQ both hit an all-time high. So now investor sentiment is in the process of shifting from greed to complacency. Considering that 5 major tech companies are the ones supporting the entire market right now, the silent pop of the tech bubble might be the black swan event that'll trigger a catastrophic stock market crash. In any case, even if that incident alone does not push the markets into a domino fall, many other aggravating factors, such as the increasing IPO mania, the extraordinary valuations, and the new metrics for valuation, the unjustifiable market concentration in a single sector and a few stocks, investors' overreaction to economically irrelevant stock splits, amongst many others, at some point will pile up together, igniting an unprecedented apocalypse inside the markets. Just wait and see.